Ni-
Your sound is a little bit distant, Chavez. I don't know if everybody else can hear you properly, but for me, your sound is a little bit quiet,
how is it now? Okay.
still quiet.
Still quiet?
For me, can everybody else hear okay? If everyone else is, it's fine.
I can
Mm.
hear him properly.
I
Okay.
can hear. Hi, Chavez.
Hello, hello. Uh, did we finish 18 or are we supposed to do?
19. We're on 20, I think,
Yeah,
today.
you're on episode
All right,
20.
Joe.
We did episode 19 last time.
Okay, let's do it. All right, so let's start episode 20 of Lift Before You Quit. And tonight, as I mentioned in episode 19, that we will talk about AI Capital Manager, how when machines begin managing capital better than humans. For nearly every generation throughout financial history, one assumption remained unchanged. The best investment decisions were made by humans. Successful investors were celebrated because of their intuition. Legendary traders became famous because they felt the market. Portfolio managers built careers around experience. And hedge fund managers were often described as possessing an almost supernatural ability to anticipate what would happen next. For decades, this belief shaped the entire financial industry. Experience was considered the greatest competitive advantage. Instinct was considered irreplaceable. Human judgment became the foundation of capital allocation. Same happened with you guys, I believe, if you recall in your, uh, you know, your childhood memory, how your parents used to allocate capital, invest in pension funds, how my parents used to invest in pension funds or mutual funds back then. It was all intuition. So the whole financial, uh, you know, uh, decision making was all intuition and experience. And we used to listen to our elders, few people who were expert in investment or who made profits, and that was just overconfidence or sometimes confidence of of having that feeling that yes, if it is a stock of this company, this is going to definitely grow. No knowledge, no prerequisite information, no understanding about the industry trend, nothing. Was just plain intuition, instinct. So, but history tells a different story. Every major financial revolution has removed another layer of human dependence. Trading floors replaced handwritten orders. Electronic exchanges replaced trading pits. Algorithms replaced manual execution. Quant models replaced discretionary decision making. Today, artificial intelligence is beginning to replace something far more valuable, not traders' decision making itself. This does not mean humans are going to disappear. It means machines increasingly assist humans in making better financial decisions. And perhaps one day they may take they may make many of these decisions entirely on their own, just like the auto trading engine, which works for you tirelessly every single day and brings you yield after every single cycle. This is not science fiction, it is already happening. BlackRock
Chavez, your sound is really low.
is low,
Yes.
I believe. Some now. Is okay?
Still the same.
I think my computer has had some coffee or tea somewhere near the microphone. Is it okay? Should I talk loudly?
A little bit louder then.
Okay, okay, okay. All right. So BlackRock manages more than 11 trillion in assets using sophisticated portfolio management technology. Two Sigma employees, and I told you all about BlackRock's Aladdin. Who did some research about Aladdin? Did you guys check about Aladdin? It's not open source. It's not a retail product, but you can read about Aladdin, how they built it, what is inside Aladdin. This is managed by BlackRock. Two Sigma employs thousands of data scientists rather than traditional traders. Renaissance Technologies built one of the most profitable hedge funds in history using mathematical models instead of market opinions. JP Morgan invests billions of dollars annually into artificial intelligence research. Nasdaq itself relies heavily on algorithmic market infrastructure. Modern finance is no longer driven solely by people. It is increasingly driven by systems. This shift introduces a profound question. If machines can process more information, react faster, remove emotion, analyze millions of market relationships simultaneously, could they eventually become better capital managers than humans? That question is becoming one of the defining conversations in global finance. Because the future may no longer belong to those who predict markets, it may belong to those who build the infrastructure that manages participation inside them. The evolution of capital management, as we discussed, in 1900s, it was all about human intuition. In 1980s, we had a little bit of computer assistance. By 2000, algorithmic execution started, and by 2010, we had quant investing, and 2020 onwards, machine learning came as a concept, and by 2030, in almost couple of years, we are expecting AI capital management thoroughly. Through AI, everything will be managed. And if you all remember from the previous episode, we understood the difference between capital management and trading. Good capital management and good trading skills are both different things. When we were discussing about prop trading, we understood about wealth management, capital management, how it is done, and how important is that when it comes to trading in this, whole financial industry. From instinct to intelligence. Imagine standing inside the New York Stock Exchange in 1985. Thousands of traders, hundreds of brokers shouting orders, paper tickets flying across trading desks, telephones ringing continuously. Every decision depended on a person. Someone watched the chart, someone interpreted the news, someone placed the order, someone manually managed the position. Human speed defined market speed. Fast forward 40 years. Entire portfolios worth billions of dollars can now be rebalanced in milliseconds. No shouting, no paper, no phone calls, only infrastructure. Today's market generates extraordinary amounts of information. Single trading day produces millions of transactions, billions of price updates, countless liquidity changes, continuous macroeconomic data, corporate announcements, social sentiment, blockchain activity, derivative positioning, funding rates, open interest fluctuations, cross market correlations. No human being can process this amount of information in real time. Even the world's best traders face biological limitations. Our brains evolved to survive forests, not financial markets. This is precisely why institutions increasingly rely on machines. Machines do not become overwhelmed. Machines do not panic. Machines do not hesitate. Machines simply process information faster, continuously, without fatigue. The objective is not replacing intelligence, the objective is expanding it. If we look at the real market, during periods of heightened volatility, modern quantitative trading firms can analyze thousands of market variables simultaneously, including order book imbalance, liquidity depth, volatility clusters, correlation shifts, funding rates, market breadth, cross exchange pricing, historical probability models, portfolio exposure, execution latency. Most discretionary traders monitor only a small fraction of these variables at any given moment. This difference explains why institutional infrastructure increasingly outperforms manual analysis over long time horizons. Human decision loop versus AI decision loop. Human decision loop is based on news, emotion, interpretation, decision, execution, and hope. Whereas AI decision loop revolves around market data, continuous analysis, probability models, risk assessment, execution, continuous recalibration. Human decisions are episodic, while AI decisions are continuous in a loop, and it keeps on repeating and recapitulating. Why humans are poor capital managers. One of the most important discoveries in modern economics did not come from Wall Street. It came from psychology. In 2002, psychologist Daniel Kahneman received Nobel Prize in Economic Sciences for demonstrating that human financial decisions are systematically irrational. His work fundamentally changed the understanding of markets. People do not make financial decisions objectively, they make them emotionally. Behavioral finance identifies dozens of cognitive biases that affect investment performance. Among the most common are loss aversion, the fear, the tendency to keep away from the loss is called loss aversion. People experience the pain of losing approximately twice as intensely as the satisfaction of gaining. Of course, the pain is pain of loss is really grave and deep, and even it is more intense than the profits, that small profits that you receive. Even the small loss is like needle in your heart always, and this is with everybody. Even if it is a dollar loss, it is a loss. Loss means red. It creates a picture in your brain that gives a different kind of psychological pain in your head. So this often causes traders to hold losing positions for too long while closing profitable positions too early. So understand this. This is human, you know, tendency to, in fear of making a loss, people close the profitable positions too early. And in fear of making a loss, people hold loss making positions too long and they face even more loss. So, this is something that is human psychology. This is not taught in finance. This is not related to finance. It is fully psychology. Confirmation bias. Investors naturally seek information that supports existing beliefs while ignoring contradictory evidence. This leads to poor decision making during rapidly changing market conditions. So, I will give you all an example. Um, how many people, how do I explain this? Let's take an example of some industry. Let's say we are talking about agriculture. Let's talk about farming. Let's take example of Cuba. There are it's called sugar bowl of the world. There are public listed companies in Cuba that that deal in sugar cane, that deal in sugar. So investing in those companies when there is harvesting season of sugarcane always gets you a profitable, hike or something that you know you can always go home with a little bit profit. So it's a prejudice that traders have built years and years, investing in um companies which produce sugar at the time of harvesting of the sugar cane. So it's a bias that has developed in your brain that tells the traders to always go in that direction, and that and and they completely ignore the contradictory evidence. I'll take an example of contradictory evidence also. Uh, Without even looking at the rainfall, without even looking at the habitable conditions of how sugarcane plantation might have resulted the production of sugar this year, or production of that particular company, that particular firm that year, people invest. So it should have been if AI would do this, then AI would first look at the weather of last 6 months, maybe 1 year, how rainfall had been there, what would be the weather condition for ideal sugarcane plantation to ripe very well and to produce good quality sugar in excessive amount. And then after that analysis, AI would have suggested to invest in that company that has produced sugar years after years. So this is the difference between the confirmation bias which traders hold, and this is how they ignore the contradictory evidence which may be present, which may be not be temporary, which may not be permanent, or something that is prevalent, something new, something exceptional, something that has a relation that not a typical biased human could understand, that maybe only be contradicted by AI or automated system that is continuously monitoring and continuously evaluating the scenario under which circumstances this stock may not go up. Humans think that this stock may go up, but the continuous analysis which runs in the background of machine learned softwares run around how this stock may not rise. So this is the difference between the AI based capital management if we compare to the the old system that is from generations. That's how traders they have been intuitionally investing money, intuitionally allocating capital. This leads to poor decision making during rapidly changing market conditions. Then overconfidence bias. Of course, we all have been there, done that. Following a series of profitable trades, many investors begin increasing position sizes excessively. Rather than attributing success to favorable market conditions, they assume superior skill. This frequently results in larger drawdowns. Then recency bias. Humans tend to believe that recent market behavior will continue indefinitely. Bull markets encourage excessive optimism, bear market encourage excessive pessimism. History repeatedly demonstrates that both assumptions are flawed, especially 2025 and 26 bull run. It never came. According to me, it never came. And we were so expecting the bull run to happen and shit coins going up, but it never did. Nothing happened this year. There was no bull run, according to me. Even according to experts, there was no bull run. So the people who had the prejudice that there will be a bull run, let me hold Shiba, let me hold Tron, let me hold this and that, they're at the same position, even they might be in loss. I'm holding a lot of Dodge for a long, long time, and I'm deeply in that pain of holding Dodge. Why am I holding Dodge? Why not Bitcoins? So this is the bias that we have as a human, and this is not going to go away, but this is going to be replaced, this is going to be reshaped with the machines that are coming, with the system that is being built in the industry. So history repeatedly demonstrate that both assumptions are flawed. Next, and the biggest of all, is FOMO, fear of missing out, the most recognizable bias in the modern markets. When prices rapidly rise, investors often abandon discipline and purchase assets solely because others are doing the same. Luna crash. Professional capital rarely behaves this way. Institutions typically increase discipline during periods of excitement. Retail participants often reduce it. That's why there's a big sweep, and the moment sweep happens, institutions enter and correct the market, and then retail enters, and then same sweep happens one more time. Retail becomes liquidity. Take real market example. During crypto bull run of 2021, millions of new crypto investors entered the market near cycle highs after months of rapid appreciation. They thought they are going to multiply their money by 20x, 200x, 300x, whatever people made at that time. They posted on Facebook, Instagram, everywhere. There were stories of people multiplying their money rapidly. Many purchased assets following extraordinary gains rather than before them. Institutional participants behaved differently. Numerous funds gradually reduced exposure as valuations expanded, rebalanced portfolios, and preserved liquidity. The most important aspect of capital management, wealth management, is preservation of capital, preservation of liquidity. And if that skill is there in a trader or in a firm, in a software, in a tool, then that is supposed to only compound with time. Otherwise, compounding is something which is impossible to do when it comes to trading. When markets corrected sharply in 2022, disciplined allocation often proved more valuable than aggressive speculation. The lesson was clear. Success was determined not by predicting the market, it was determined by managing capital. Human biases versus machine discipline. Same things that we discussed. Human behavior revolves around fear, greed, panic selling, revenge trading, overconfidence, emotional decisions. AI behavior is about risk model allocation rules, probability analysis, portfolio optimization, statistical validation, continuous data processing. The greatest advantage of AI is not speed, it is the absence of emotion. It is the absence of intuition that this is going to definitely happen. There's a harvesting season of sugarcane. The stock price of sugar producing companies are going to definitely rise. Let's buy some lots of the newly listed companies. These all biases, they do not confirm that the trade is going to be profitable always. The financial industry has spent decades attempting to improve human decision making. Artificial intelligence takes a different approach. Instead of improving human judgment, it reduces the need for it. Machines never become tired. They never experience fear. They never chase headlines. They simply analyze, calculate, adapt, repeat. But one most important question still remains. If artificial intelligence can remove emotion, how does it actually manage billions of dollars? How do institutions trust machines with enormous pools of capital? That answer begins with modern AI portfolio manager. Inside the AI portfolio manager, if you ask most investors what artificial intelligence does in finance, the answer would probably sound familiar. It predicts stock prices, it tells you when to buy, it finds the next Bitcoin. Those assumptions make exciting headlines, but they are largely incorrect. The world's most sophisticated AI systems are not trying to predict tomorrow's price. They are trying to answer far more important question. How should capital be managed right now? This distinction changes everything. Professional capital management is not about finding one perfect trade. It's about continuously answering thousands of small decisions. How much should be invested? How much should remain in cash? which sectors are becoming overexposed, where is volatility increasing, which positions have become too large, which assets are becoming highly correlated, how much downside exists if market reverse tomorrow. I believe you all remember the correlation magic in trade. If you buy Bitcoin, Ethereum, Solana, and Bitcoin falls, you fall in all three positions. That's the correlation magic that happens. How much downside exists if market reverse tomorrow? Should exposure increase or should it decrease? A modern AI portfolio manager evaluates these questions every second, not once a day, not once an hour, continuously. Unlike human traders, artificial intelligence never stops monitoring the portfolio. Every market movement becomes another data point. Every trade updates probability. Every economic announcement recalculates risk. Every liquidity shift changes exposure. Portfolio management becomes a living system. Instead of asking what's the next trade, AI asks what's the healthiest portfolio. The subtle difference separates speculation from capital management. Inside AI portfolio manager. So I'm going to repeat. Global market data, market scanner, risk engine, portfolio optimizer, allocation engine, execution infrastructure, continuous monitoring. This all repeated every single second. Modern AI doesn't manage trades, it manages portfolios. Let's discuss about BlackRock's Aladdin. One of the most influential financial technologies ever created is not trading bot. It is it isn't even publicly available. It is called Aladdin. Developed by BlackRock, Aladdin has become one of the world's most advanced investment and risk management platforms. Today, the system helps oversee portfolios representing trillions of dollars in assets for financial institutions around the world. Despite popular belief, Aladdin is not an automated stock picker. It is something much more important. It is an infrastructure platform. Portfolio managers use it to understand risk before risk becomes visible. Every day, Aladdin analyzes enormous quantities of financial information, interest rate changes, bond yields, credit exposure, currency movements, commodity fluctuations, sector concentrations, portfolio correlations, macroeconomic scenarios, liquidity conditions, stress testing. Thousands of variables interact simultaneously. Instead of simply asking, will Apple go up? The system asks what happens to this entire portfolio if interest rates increase by 1%, oil falls 12%, the US dollar strengthens, and the equity volatility doubles. This is a conditional, correlation of events that may, consequentially affect the particular buy or sell of Apple stock. That is institutional thinking, not predicting markets, preparing for possibilities. This distinction explains why the world's largest asset managers focus more on portfolio resilience than individual trade selection. Professional investing is rarely about finding certainty, it is about managing uncertainty. During periods of market stress, institutions often run thousands of simulated scenarios before making allocation decisions. Instead of assuming one future, they evaluate hundreds of possible futures. This process is commonly known as scenario analysis and stress testing, and allows portfolio managers to understand how different combinations of events could affect capital preservation. And you can do that in Rift as well with the demo trading. You can take these same assets in demo trading and you can see how the portfolio is growing on one phone, and you can simultaneously trade on another device with the real trading mode with the same assets. Probably the same. You can find. Retail investors rarely perform this type of analysis. Institutional infrastructure performs it continuously. How Aladdin thinks. Market data, interest rates, inflation, liquidity, correlation, volatility, portfolio exposure, risk score, capital allocation recommendation is produced by all these factors continuously being analyzed over and over every single second. Institutional systems optimize portfolios, not individual opinions. Why hedge funds hire engineers? Another interesting thing. Walk into a hedge fund 50 years ago, you would mostly find traders. Walk into many of the world's leading quant firms today, and you will encounter a different workforce. Mathematicians, computer scientists, physicists, machine learning engineers, statisticians, data architects, software developers. This shift reflects a deeper transformation. Modern finance increasingly resembles an engineering discipline. Take Renaissance Technologies, one of the most successful hedge funds in history. Founded by mathematician Jim Simmons, the firm became legendary not because it hired celebrity traders, it became legendary because it hired scientists. You can search about Technologies. It is one of the most successful hedge funds in the history. Uh, its employees analyzed patterns that were invisible to discretionary traders. Rather than searching for opinions, they searched for statistical relationships, tiny inefficiencies, recurring probabilities, behavioral anomalies, execution advantages. When those advantages appeared, algorithms acted without hesitation, without emotion, without fatigue. The same philosophy can be seen at firms such as Two Sigma, Citadel Securities, Jane Street. You guys can read about these firms as well. These organizations process enormous data sets every day. Satellite imagery, same thing that we discussed about. Take example of sugarcane farms and sugar prices of stocks, satellite imagery, weather patterns, shipping activity, credit card spending, social media sentiment, blockchain analytics, macroeconomic indicators, derivative positioning, alternative data. The objective is not to predict perfectly, it is to improve probability. Even a small improvement becomes powerful when repeated consistently across millions of transactions. The modern hedge fund. Traditional firm included traders, their opinion, trade and result. Quant firms, which are modern hedge funds, they include data, models, probability, risk, execution, continuous optimization. The competitive advantage has shifted from intuition to information processing. AI doesn't predict the future. One of the greatest misconceptions about artificial intelligence is that it predicts markets with certainty. It doesn't, and neither do institutions. Professional finance has been never built on around certainty. It has always been built around probability. Imagine flipping a coin. Nobody knows whether the next flip will land on heads, but everyone knows that over thousands of flips, the probability of approaches 50%. Financial markets work in the similar way. No institution exactly knows what Bitcoin will do tomorrow. No AI system can guarantee the next move in gold. No model can eliminate uncertainty. Instead of artificial intelligence attempts to answer a different question, given everything happening right now, what is the highest probability allocation? That single change in perspective transforms investment philosophy. Prediction seeks certainty, probability manages uncertainty. This is why institutional investors often appear calm during volatile markets. Their systems are designed to adapt as probabilities change, not to defend predictions. The best AI systems never become emotionally attached to forecasts, they continuously update them. Real market example, let's say Consider two portfolio managers during a sudden market correction. Manager A believes that market will recover quickly. He refuses to reduce exposure because he wants to be right. Manager B allows probability based system to evaluate changing volatility, liquidity, and downside risk. The system recommends reducing exposure by 20% not because it knows the future but because probability distribution has changed. If markets recover, exposure can increase again. If market continue falling, capital has already been protected. The objective is flexibility, not prediction. Prediction versus probability. Prediction is all about I know, high conviction, high emotional attachment, and large mistakes. Probability is about it is likely, continuous updates, adaptive allocation, and controlled risks. Professional finance is not built on probabilities, is built on probabilities, not certainty. Artificial intelligence is not replacing investors because it is smarter, it is replacing parts of the investment process because it is more consistent. Machines never become overconfident after a winning streak. They never panic after a losing. They simply evaluate probabilities, monitor risk, and adjust capital accordingly. That is why world's largest institutions increasingly trust systems with decisions once reserved for humans. But one question still remains. How does artificial intelligence decide where capital should move? How does it balance growth, preservation, liquidity, and opportunity across constantly changing markets? That is where autonomous capital allocation begins, and it forms the foundation of next stage of financial evolution. Autonomous capital allocation. We will start from Wednesday. This is a long episode of 90 pages, so I will not over, fill your heads with a lot of information.
Amazing. Fantastic. Chavez, it's such an education and it's just fantastic to get all of this. There's a particular section in there where you talk about confirmation bias. And I think that is such an intrinsic part of human nature. We apply confirmation bias to practically everything in our lives. My child is perfect, and we seek all of the evidence to confirm that. Yeah. Every decision you make, you want to be the right decision. And of course, you look for things to confirm for yourself that you've made a decision, whether it be voting for a particular party or whether it be eating out. You go to that restaurant because of ABC, forgetting whatever else, what other evidence may say. It's such an intrinsic part of human nature that it is inevitable that it is going to be an intrinsic part of one's decision making in the trading world.
Right, right. And it's everywhere. I think even, the moment you step out of your home, you, even if you cross signals, you take right turn, left turn, it's a confirmation. It's a bias that you walk with, you drive with. It's always, I know that street is not going to have heavy traffic.
Yeah, yeah.
It is going to be everywhere, everywhere.
Even when the sat nav tells you differently. Yeah, perhaps a few comments from the panel.
One of the things that I was most impressed with is the Renaissance technology, how they switch from the predictable or financial traders who just know probably have been trained in just doing one thing and looking at charts and this to the variety of engineers that were hired to be able to study as far as the probabilities are concerned. And the thing about it, it just makes such good sense to have such a variety of people. And every time I'm here at this you go through an episode, Chavez, I become to feel very exposed in that when you were talking about the psychology of holding on too long to what seems like a loss, hoping that it would, I think that's recency bias, hoping that it would recover and you fall into a greater loss, or um, going ahead and cashing in on a profit too soon. I feel like you're looking at my cards.
But
Uh,
same is with that's
Chavez,
human.
hi.
Hello, Rajit.
Just wanted to ask one question. You spoke about Aladdin so much. So, could our platform Rift be building like something similar? Obviously, not at that scale, but something like that on that scale.
I also have no idea what is Aladdin.
Uh,
I just have read what you can read on internet. There is
no,
no
I
source code.
okay.
There is no
I'll tell
source
you.
code. You can just imagine.
You had told me, you had told earlier to everyone to read about Aladdin. So, of course, I had done it. It was too much to understand. It was like too heavy, but little bit I could grasp. But I have done a lot of this thing on the ChatGPT for our Rift also. So, it automatically gave me a, a comparison that could a platform like Rift build something similar? So, it says based on what you have shared about Rift, yeah, it is something similar, but in a very small and it is explained like what it.
Come on, you cannot compare Rift with Aladdin. That is really big. They manage, it manages trillions of dollars of
Yeah,
TCS.
that is trillion, this is millions, but it is going towards that. The
Of course.
methodology,
Of
methodology.
course. I mean, the same thing that we are also doing. We have also hired engineers. They are building the whole, setup. We have not hired traders to build the app. We have not hired traders to build the automated trading engine. Engineers have built it. So the psychology, the foundation, the objective is same. But tech-wise, I don't think we'll be there. We are there yet, but we may be. We hope
We
so.
will be. We will be, not may. Why may? We will be. Maybe 2 years, 3 years, 5 years down the line. But yes, we will be.
Of course,
Will be, not
of
will
course.
be.
I mean, if we look at our history coming back from a concept like boomerang and landing it to a flawless concept like Rift, I think we have come a long way. And I just sit sometimes alone and imagine, delivering even more powerful product than Rift or something even more incredible or reshaping Rift even bigger, post 5 years from now, how incredible that would be. After years and years of learning experiences, understanding market depth analysis, our brains as an engineer, our mind, our tech team, how they are grasping, how they are delivering, how they are shaping the tech is also improving a lot. And maybe a couple of years from now, we will be, delivering something crazy, extraordinarily, innovative. Never know.
Well, it's time for Chantel leaks. So, but the thing, and then I want to ask a question after Chantel leaks. So, Chantel?
Chantel, how
Yeah,
are
well,
you?
I thought tonight it is Rajiv Leaks because he is bringing Aladdin, and all you need to do is that lamp. You just give it a nice little push, and you
Rub.
get you get inspired. So I'm following the inspiration of what Chavez is first Rajiv and then Chavez are discussing. How would it be? We all know, doesn't matter in which country you live, we all know what a pension is.
Uh-huh.
So what if Rift would be the the name that everybody knows? Okay, with Rift, you get your exponential money and you don't you get it automated through trade. I think you have built such a powerful essential wheel in this ecosystem, Chavez, that nurturing it to be a category brand, the name in the category, is is absolutely an amazing milestone that we can have.
We are like, I feel that we are already on the path of, becoming a
Exactly.
kind of an operating system,
Yeah.
AI based, digital asset investment operating system entirely. Like we are building our own operating system, basically.
Yeah,
Of course,
Chavez is.
That's how
Huh?
marketing it.
definitely we are moving towards full automation, and as we are moving along, you know, with Rift only, I mean, you guys imagine when I gave you the demo mode, you guys imagined only swipes are going to, help you make money. And then we gave you the first demo mode, made you all really confident, and then you guys thought we are going to really crazily, you know,
Your
take
sound
it.
is dropping away again, Chavez.
Ah, of course. So
Hmm.
with the demo mode only, you guys had a different kind of perspective with the Rift versions coming, and then we gave you the auto trading engine, and you guys had, you changed your perspective about Rift the entirely, and your thought process, your psychology, your visualization of Rift, post 5 years changed entirely when you saw the auto trading engine. Now, after I believe couple of months of operating with auto trading engine, looking at the smart money, using smart money, predictions, not closely prediction. Prediction is just like another starters recipe that we added in the platter, but yeah, we did that. But smart money, and what is
Hmm.
the bigger connection that we can do with prop trading and smart money, how broadly we can diversify the expert traders and bridge them towards smart money, and expose them to retail as well to take advantage. That kind of, bridge, that kind of wide aspect thinking is running behind the team now. But you can also imagine how the understanding of Rift, perception of Rift has changed over deliverables after deliverables.
Yeah.
So sometimes I also imagine, like, what are we going to consume after 3 years from now? It's going to be
Well, what
crazy.
you've done, Chavez, of course, is you've fulfilled people's imaginations. Because remember, most people are not even moderately experienced traders. Most people don't even come into the category of novice traders, but many people understand how trading, the concept of trading works, and how so many people have made so much money through trading. But inevitably, most people are looking for the simplest solution. And of course, the auto trading engine provides that. It's perfect for most people. I work, I don't have time to sit and watch charts. If I place a trade, by the time I finish my 2 hour driving lesson, I've missed the point of where I could have collected. So for most people, as Chantel said there, you know, that's the whole point of a pension, being able to invest your funds and forget about it and allow it to grow. And
Uh,
that's the circumstances within. You know, going to what you were saying about you're sitting and imagining, you are bringing to fruition most of your imagination. You also talked about learning. I keep my sunny disposition and cheerful mood and positive attitude by watching a lot of positive videos. I came across a great video the other day, which had Ed Sheeran in an interview, and he was saying, he says, "Look, you learn nothing from success, and you learn everything from failure, and that is the journey that everybody goes through." And it was it's something that everybody probably knows, but something that nobody really thinks about, because everybody wants success, but they don't want to go through what it takes to be successful. But as a community, as a company, we have been through the ups, we've been through the downs, and you have demonstrated that from every step of this journey, you can learn something and you can improve something, you can adapt something, and you can make it better and you can bring it to reality. Simply a case of not giving up. And that's what you've brought to this community, Chavez. So You know, our hearts belong to you and our loyalty belongs to you. We will never
Well, Joe,
unappreciate what you're
yeah,
doing.
Joe, you know, the thing about it is that people do not understand that you cannot recognize success unless you go through failure.
Yes.
That's one of the things that just don't
Yeah.
wish to go ahead and
You
recognize.
don't know if the light's on unless you've been in a dark room, right?
Exactly, exactly, exactly. Chavez, one of the things and I don't want to drag this on, and perhaps you can, once you continue with episode 20 on Wednesday, I suppose, from page 44, you will talk more as far as if AI is not going to predict the future, the improvement of probability, improving probability, why does that not look like a prediction of the future?
Uh, that's not prediction, that's calculative, that's mathematics, pure mathematics. That's never intuition. That's not, it may happen. It is most likely to happen. It is all about this may or may not happen, reasons why it may not happen, reasons why it is most likely to happen, reasons why it is less likely to happen. On all the reasons collaborated, creates an opinion that's probability. And that's how machines they work, and that's how they analyze and give you a conclusion that by this may grow, this may not grow by at this quantity, this may be your exposure might be this, and you can uh, because it's managing the whole portfolio, you can afford to take this kind of risk with this kind of money only. That's how a smart portfolio manager would suggest you. And
I see.
that's what AI is doing already.
I see. Okay. So it kind of narrows the your options, kind of helps you to be able to make a better decision.
It's basically reassessing the factors that possibly affect the possibility of happening price going up or down. We will not mix probability with predictions here. I'm going to mix probability with prediction in episode 21 and 22.
Oh, great.
That is already there. So, but that thing is, I mean, that we will not try to mix here. Understand, probability and prediction both are totally, entirely different things. AI does not predict, it works on probability and reassessing that probability, and it breaks it down into milliseconds also that may influence the price going up or down.
Okay.
And that's how it has the edge.
Okay. Fantastic. Um, uh,
Fantastic. Oh, sorry, Grace, if you've got more to ask, my apologies.
no, not at all. Not at all. I was just going to
Terrific.
yield to you.
Thanks very much, Grace. Yeah, some excellent points here. I wonder, Chavez, if we can't call it prediction, could it be called anticipation?
It's probably it's mathematics. It's
Yeah.
just finding the odds of happening, most likely to happen or not to happen, and what are the factors influencing that, and why decisions should be made.
Mm,
You know, and that brings us rather neatly, I think, to the end of today's Zoom. Why should you be here? What's the probabilities of you being here on Wednesday? What's the necessity? And of course, for me, there is only one answer to that, and that is that we should be here every day. Where else are you going to go to get this kind of education? More importantly, where else are you going to go to get this kind of education for free? Is there any other companies out there that are providing as much support, as much training, as much education, as much understanding as us? I think that's very unlikely. We are the one and only. We are the best. And this is where you should be bringing your people. Because this is, after all, your affiliate marketing forever home, as has been coined many times. We've got our 3-year roadmap firmly under the feet and working our way through it. and we are going to be the company that stands strong, stands tall, not by bringing down other companies, but by making sure that we achieve all of the things that others did not, could not, would not, and had no intention of doing so. So, Chavez, what can one say? Thank you very much for your time. I'm sure it's an invaluable time for us. I'm sure it's a very valuable time for you, but we do appreciate every minute that you spend with us when you're able to be with us. We know when you're not, that you are working hard in the background to ensure the security and the future of this company and this community. Thanks to the panel for everything that you have brought to the discussion. As always, it is incredibly valuable as well, because it opens the door to thought. It opens the door to consideration. And who else to thank? But of course, all of you who join us every single day, showing your support, growing the community, and helping others understand what an exciting place this is. So, one last thank you to obviously to Sue and Izzy for manning the gates and making sure that we all stay safe. There's lots of boogeymen out there, and we need people at the door. And there's no fearsomer couple than Sue and Izzy to man those gates. We will call it an end for this evening. Come and join us again for the replay on US prime time at 7 p.m. EST. And of course, join us again tomorrow evening for UK prime time for business presentation night. Bring your community and help them understand exactly what they are missing out on. Thanks very much, everybody. We'll see you soon.
Thank you. Bye-bye.